Welcome to the current federal tax developments for the week of November the 11th, 2019. Current federal tax developments are brought to you by Kaplan Professional Education and by your state society of CPAs. This week, we're going to take a look at what's happened in the past week in taxes. Going to start out looking at a case that came down from the federal circuit that taxpayers may not be thrilled with, who had failed to report foreign bank accounts because what had looked like a potentially promising defense to at least reduce the maximum penalties down to only $100,000 ends up being rejected by the First Circuit Court of Appeals to consider it. We have the IRS issue inflation-adjusted numbers, both the general ones and the ones for qualified retirement plans. And we also have the IRS proposing new tables that would be used for required minimum distributions beginning in 2021. So we'll get ourselves running this week, and let's start with a few issues that we've got going. So let's go ahead and, take a look too at the fact I want to remind you that coming up at the end of this month on the 26th of November, we are going to have a rebroadcast of a course I'll give this week in Arizona. So I will tell you about later on when the live session will be. So if you want to sign up for that, you can. But we'll be rebroadcasting on November the 26th, Section 199 Cap A. That'll be, 199 Cap A Explained. I'll be planning for the qualified business income deduction. That'll run at 6 a.m. and 8 a.m. Pacific Standard Time on that rebroadcast day. Many of our state societies here have access to the Cal CPA rebroadcast. If you want to participate in that, you want to sign up for that course, you can. You'll probably get your state society discounts if you go that route. So you can look at doing that. There are two start times because it depends on what part of the country you're in, which one makes the most sense. But take a look at that on November the 26th. You can take a look at your state society website. You can take a look on Cal CPA's website to find the links to sign up for that course. Let's start with our first case of the week. This came out of the Federal Circuit Court of Appeals. It is a case of Norman versus United States, case number 182408. The decision was issued on the 8th of November. And this is a case that looks at the problem when a taxpayer has failed to actually file the FBAR report every year. And probably also failed to report all the income from the account in those years. And the question became, what is the penalty that's imposed, or what is at least the maximum penalty that's imposed if you have a willful failure to file the form? And under the law, Congress in 2004 updated the law to provide that the maximum penalty to failure to file an FBAR return willfully is limited to the maximum of the amount in the account at the time of the violation, or I should restate this, the rule prior to 2004. So let's keep that in mind. You could have a maximum penalty of $100,000, not to exceed the amount in the account, or $25,000. Now, what's happening now is Congress has set the maximum penalty to the greater of $100,000 or 50% of the amount in the account, whichever is greater. Now, this change in 2004 was made at a time when Congress was trying to crack down on failures of taxpayers to report overseas monies. And this would continue on, eventually leading to the UBS settlement, where UBS agreed to provide information about accounts they were holding for U.S. citizens. And that will come into this mix as well. One of the things that happened is that we've had cases recently, while the law was changed in 2004, the IRS has never updated the regulation. That failure to update the regulation has caused some courts to say, well, the law said the maximum penalty shall be greater than 50% of the balance of the account, right? That'll be our limitation. So we could go up to $50,000 balance of the account or $100,000, whichever is greater will be our maximum penalty. Well, the court said, yeah, that's true, but since the reg still has the old rule that would limit the penalty to $100,000 in all cases, that they interpret that to mean that, well, the law gave the IRS the authority to set a lower maximum by regulation. Congress just said the most they could charge you. And since the IRS could set a lower maximum, they don't have to charge the maximum. That basically they could put a reg in place that would have the lower number. Because they had never changed the 2004 numbers, the 2004 regulations, the theory of the cases went, and we discussed some of these back in 2018, two cases that held this way. There have been others, there have been some that have gone the other way, including this one at trial. Where basically they said, well, sorry, IRS, I know that the balance in the account was $2 million, that 50% of that is $1 million, and that based on the language that Congress put in, it would seem like the penalty would be $1 million. We think no, because of your regulation, the most you can get penalized them for failing to report that account is $100,000. In this case, we have a teacher, which is probably also slightly unusual because I doubt we have many times we have teachers in cases like this who have these offshore accounts. But Ms. Norman had an offshore account, and she'd had it for quite a few years. And she had set it up with UBS. She set it up as a numbered account. Now, maybe there's a totally innocent explanation for why one would have a numbered account, aside from just not wanting the IRS to be able to figure out who's attached to the account, or any other agency to figure that one out. But, kind of seems like it might have been to try to avoid reporting the taxes on this. Now, during the time she had interactions with her representative at UBS, she actually worked with them on investments. She did have a rule that they couldn't invest in a U.S. company. Okay, that also looks like she was trying to avoid any sort of linkage where there would be some way for the U.S. to find out about her. And of course, she apparently didn't report this income on her return. She also didn't report, that she had a foreign bank account. And this is a problem because she did have an accountant who handled her return. And the accountant every year sent her out the organizer. And of course, the organizer asked her if she had a foreign bank account. And she nicely checked off that no, she didn't. And she signed off on the return with Schedule B saying that, hey, I don't have any foreign bank accounts. Now, problem hits her. She discovers in 2008 that what happened was that UBS got into this settlement with the U.S. government, and they told her that they were going to start putting her name on the account, that they would have to report her activity to the U.S. government. She was not happy with this. She did transfer her account to a different foreign bank to get away from UBS. But she apparently decided at that point that maybe she should try something because UBS is probably going to turn over information about her prior accounts. So she did go to another accountant, and she told the other accountant that she had this offshore account. The other accountant late filed FBAR returns and other documents. And that started an exam. Problem with this exam is that she kind of, lied about the issue. She lied. She indicated that, well, she didn't know she had the account. Then when the IRS discovered that she had had interactions with the account directly, talked with the person managing the account, that she had directed investments, well, she didn't think it was hers. We also established that. So we have a lot of problems. Ms. Norman does not end up being the most sympathetic of taxpayers when it comes to these penalties. The IRS imposed a penalty of 100% in the year 2007, which was a year that's before the court. That penalty amounted to over $800,000. Now, the First Circuit Court of not First Court of Appeals, this is the first Court of Appeals to rule on this issue. It is the Federal Circuit. The Federal Circuit is going to rule on the question. The Court of Claims had ruled that, sorry, Congress clearly meant for this to be a higher penalty, that the IRS could impose $800,000. Ms. Norman said, well, I don't buy that. I'm going to go ahead and appeal this because other district courts, etc., have ruled that this number should be only $100,000. I think they're correct, so I'm going to go forward and try this. Unfortunately, the Federal Circuit didn't really buy her theory. What the Federal Circuit said was, the 2004 congressional law clearly was meant to invalidate those prior regulations. The 2004 law, does that. So the fact the IRS has not updated those regulations following this law does not mean they somehow are meant to override this law. Rather, the court says the law overrides that. Congress took action to take steps. In fact, the court went so far as to say that based on the language in the law, the IRS has no authority to set a lower maximum. There's a lot of interest about the word may in the sentence. But the court said all that says is the IRS has discretion whether or not to impose the penalty. But they do not have the discretion to change the penalty. If the penalty is imposed, then the maximum penalties cannot be changed by the IRS via regulations because Congress set maximum penalties in the law. The IRS has no authority to make such a change. If the IRS tries to make such a change, they are exceeding their authority, and therefore she has an $800,000 penalty due. Now, she also tried to argue, again, might as well try everything when you go into appeal, when you go into the appellate court, right? that, well, no, she wasn't really willful. The court didn't buy that. The court said there was all kinds of evidence that you knew it was your account. You knew about all this stuff. You knew you should have been reporting it. And then she said, but you know what? I failed. I just didn't read the 2007 return. I didn't realize my CPA had checked those boxes and said I had no foreign bank account. I didn't realize what was happening. You can't be willful if I just didn't notice it wasn't there. And the court very clearly said, look, you as a taxpayer never can tell us that you didn't read the return, and for that reason, you're not responsible for things on the return that you should have noticed. It's not that difficult to read the yes-no question at the bottom of Schedule B and determine, did you have an interest in or signature authority over a foreign bank account? That clearly should have been answered yes. It was clearly answered no. No special expertise be necessary to figure that one out. As such, you need to understand that you cannot come in here now and say, oh, I didn't intentionally violate the law because I didn't sit down and read the return and notice there were those questions on the return. I just every year got the return from the accountant and signed it. Now, that may sound familiar because a lot of us have clients who seem to believe that's all they have to do. Grab the return. Their key question is, do I owe? And if I don't owe, what's my refund? And then where do I sign? That is not adequate. If anything goes wrong on the return, if there's an error on the return that the taxpayer should have caught, if then they would have caught had they read the return, they're shirking their duty, and the court will throw the book at them if they try to claim that, oh, I didn't read the return. Now, that's not the same as if there's a complex issue that they really couldn't have understood. They gave the professional all necessary information, and the professional gave them advice, turns out to be wrong. That's a different problem, but this is not falling into that category. And this is doubly important because remember, we talked a couple weeks ago. The IRS has added to Schedule 1 of Form 1040 for 2019 a question asking, did you have any virtual currency transactions? That question is going to be used in the same way the Schedule B question is used to hang out people like Ms. Norman, stating that, sorry, you were told this was reportable. You were asked specifically if you had any, and you said no. And it's here on the return that you signed. And it's not going to be a defense to claim, well, I didn't read that. I just signed the return when the CPA gave it to me. That's not a defense. So, be careful on that one. But ultimately, what this shows us is good news is that this is only the federal circuit, so it may still be that some other circuit will go the other way. But it's not good news that the only court of appeal to rule on this $100,000 theory for maximum penalty for FBAR has now ruled against the taxpayer. So, yeah, I'm sure people are still going to keep trying it. I'm sure we're going to see it, but I also suspect the IRS is likely to try to take these cases up. Now that they have one on record, they'll be a little more apt to want to take the course up or take this up to the Court of Appeals if they do get a loss on it, figuring that a new Court of Appeals will pay attention to the fact that another one has already said, no, sorry, that whole theory just doesn't work. Well, this was a week for indexing, and let's talk about our first indexing issue here. This was in Revenue Procedure 2019-44, and in 2019-44, we got the basically inflation-adjusted numbers for 2020 returns. Now, this is what we're going to need for all the planning we're going to be doing. This has every single inflation-adjusted number in it, and we're not going to go through and, by rote, list them all here today for you. We'll talk about some of the key ones, but all of those are available in the revenue procedure itself. You can download that from the website, or I should say, you can download it. We've got the link in our materials as to where the IRS has this in Rev Procedure 2019-44 that will have every number in it. Some key things. Well, it does have things like the tax brackets for next year, and that's for individuals and for estates and trusts. So that's kind of useful. We have that. It does tell us what the 179 limit will be for next year. That's not as big a deal because with bonus depreciation it's become less significant, but there are still some things that you can only get 179 on that you cannot get bonus on. So if you're using that, the max limit for 2020 will be $1,040,000, and the phase out will begin at total additions of $2,590,000. Also, we have the updated 199 Cap A threshold amounts. Remember, if we're below the threshold amount, You will file using Form 8995 to compute your qualified business income deduction. And you don't need to worry about the W-2 wage limit or whether something is a specified service, trade, or business. After we clear these numbers over the next $100,000, we will phase in, phase out, depends on how you look at each one of them, the SSTB disallowance in total and the limit imposed by W-2 wages and UBIA. That threshold for 2020 returns will rise to $326,600 for a married couple filing a joint return and $163,300 for all other returns. One little neat thing there, you may remember that for 2019 we have this quirky, slightly higher number for married separate. That goes away. This is probably going to come and go over the years because the inflation adjustment calculation here gets a little bit different. And the two aren't linked. It's not just that the married filing separate is one half of married filing joint. It's a little more complex than that. That's why we can get a slightly different number. But for 2020, it will still be the same number for both, $163,300. For 2019, as I recall, we get $25 more if we are filing married separate. The limitation on the use of the cash method of accounting. Right, remember, everybody can opt into cash method, ignore 263 Cap A. They can decide not to use 471 inventory methods. And you can be a small contractor if your average sales for the past 3 years, average revenue from your businesses, has been less than what was $25 million in the Tax Cuts and Jobs Act, but it was inflation adjusted. That went up to $26 million last year. It will remain at $26 million. I should say going up $26 million for this year. It will remain at $26 million for 2020. The excess business loss rules. That's also inflation adjusted in the TCJ. This said if you had net business losses of more than $250,000, or if you're married filing joint of $500,000, that excess loss would be disallowed and treated as a net operating loss in the following year. Those numbers go up for 2020 to $259,000 for single individuals, or for anybody except married filing joint, and to $518,000 if you're married filing a joint return. The total limit on lifetime transfers, the basic exclusion amount for estate and gift tax purposes, will rise to $11,580,000 next year. And the annual present interest gift exclusion will be $15,000 for 2020. Now, please remember, these are all 2020 numbers, so this is for planning. This is not what you're going to use for the end of this year. For the end of this year, you want to go look at the numbers we got last year about this time that give you all the 2019 numbers. But in many cases, when we're doing year-end planning, part of the issue is going to be, well, what if we don't do it this year and we do it next year? Or do we have a little more leeway next year? And that's why it's really helpful to know these numbers at this point in time. They came out a little bit later than normal this year, but not horribly. So we're still here early November. Lots of times we've seen these toward the end of October. This is not horribly bad. November the 6th is an awful date to get them. So we do have them here for these numbers. Now let's go on to proposed regulations here under 409 of the Internal Revenue Code. This is found in Reg 132210-18, proposed regulations, issued on November the 7th of 2019. The IRS is proposing to update the life expectancy tables that are used for retirement distributions. This had been part of an executive order that was issued on August the 31st of last year for the IRS to look at updating these tables that had last been updated early last decade. So the IRS is going to come back in and propose new updated tables based on life expectancy numbers that exist today. Life expectancies have been increasing over the years. So that means that we fully expect that these numbers, in essence, the amount of required distributions would go down, and that would be the effect of these tables for the most part. One key takeaway, these are proposed regulations, not final. So you have to remember that when you look at these. And number two, they would first take effect for distributions in 2021. These will not impact 2020 distributions. So the first time we'd worry about these would be for 2021. Other thing to remember, we do have the Secure Act still floating out there that may or may not be passed into law. And it would switch our RMD start dates from 70.5 to 72. So that's also in the mix of all of this. But even if Secure Act doesn't pass, these changes in life expectancies would still be able to go into effect because these are regulations under the old law. So let's talk about what the IRS did in this case. Well, they published a brand new uniform life table. Okay. Now, the uniform life table is what we normally use for IRA distributions and qualified plan distributions when a taxpayer hits age 70 and a half. The only reason you don't use these tables is if the beneficiary and the sole beneficiary of the account is the taxpayer's spouse, and that spouse is more than 10 years younger than the taxpayer. If not, if that's the case, then we use the joint life expectancy tables using the actual basically the actual age of the spouse instead of assuming they're 10 years younger. And we have some of those. I have some clients that's the way we do it. But obviously, for most clients, it's going to be the within 10-year rules. And even for those clients where there is a 10-year difference, when the younger spouse begins to hit their minimum distribution ages or their RMD ages, obviously their spouse is not 10 years younger than them. So at that point, they'll still be on the 10-year statute. So that's why these standard tables, the uniform life tables, are the ones that really matter for the most part. The initial standard uniform life table at age 70 would go to 29.1. It is currently 27.4. So that's going to have a decent reduction in what that distribution would be for the first year. So we will have this. There are some special rules also in here because here's the catch. We're going to now change the factors. And you might have a concern. What if my taxpayer under age 59 and a half is currently receiving substantially equal periodic payments? These new tables are going to change the factors from what we were using before. There is a special rule proposed in the regulation to deal with that. So when we shift from the old tables to the new tables, that will not be considered to be a change in the amounts we're distributing. That would trigger the penalties going all the way back to day one on these amounts. So there is some protection for our clients who are taking those substantially equal payments. The tables have all the other tables that you may be involved, like I say, joint life expectancy, single life expectancy for inherited IRAs, and basically all of them are looking at longer life expectancies these days because life expectancies have improved since the tables were last updated, going on not quite 20 years ago, but going back pretty good distance. So we do have brand new tables, but please remember they do not take effect until 2021. So don't start computing anything with these for purposes of taking actual distribution, but for purposes of planning going forward, yeah, I'd start looking at these. I think there's a real good chance that we don't get a lot of comments on these, there's not a lot of complaints, and that these updated numbers go into effect in 2021 without much hassle. So when we switch those new tables, yeah, that'll be a different issue. Finally, the IRS issued the 2020 inflation-adjusted numbers for retirement plans. So we're still staying on retirement plans right now. This is Notice 2019-59, issued on November 6th of 2019. This is our annual notice of retirement-related inflation adjustments. And what's kind of interesting is it was issued early in the day when they start issuing these things, and then late that afternoon they released the second set of numbers. So this is the annual limitations. Now, there's a number of things in here, various interesting numbers. But let's talk about some of the key ones. The one that gets the headlines, and the one you probably read about in the general press, is the maximum deferrals to 401k plans. Those will go to $19,500 in 2020. So your clients can jump their number of deferrals. The catch-up contribution will become $6,500. That's up from $6,000. So it means that while in 2019, your client who was over age 50 could do a max deferral of $25,000 from their payroll. Now, next year, what we're going to see is they're going to be able to do $26,500 extra on the general deferral plus $500 extra on the catch-up. So if they're maxing out, they're going to get a whole $1,000 additional contribution. The maximum that can be allocated to any employee's account in a defined contribution plan will rise to $57,000 for that year. The maximum defined benefit you can fund for will go to $230,000. The annual compensation limit, this is the amount of compensation you consider in allocating to somebody's account, an employer contribution, or that you can consider for defined benefit purposes for how much you're considered to have paid them this year, is going to rise to $285,000. That's up from $280,000 in 2019. Okay, simple deferrals actually went up for the first time in quite a while. If you still have a simple plan, the deferral limits go to $13,500, up from $13,000. Now, as I've kind of told people for a long time, I think seriously you have to consider every year, if your client has a simple, whether or not they might be better served by a regular 401k. The reason why, if you have a client who's actually maxing out at 13.5, the question is, would they want to go all the way to 19.5? And if you had a safe harbor 401k, it probably would give you a very similar result to the simple, but with the ability of being able to get another $6,000 in there for your highly compensated individual, or potentially, as we say, significantly more money in there. So if you're actually maxing out and they're starting to, you always want to kind of double check to make sure the simple's there. The simple does have the advantage of no 5,500, so some people like that, but it's messier. It has some quirky rules, and I've always thought that, yeah, the simple was the Congress's attempt to test out what later became safe harbor 401ks. It's kind of like the MSA was the predecessor to the HSA. If you still got an old MSA, you can use it, but we're not really allowing new MSAs to come into play. So we have that in place. IRA numbers are also updated here. We're moving slightly up at how much you could have an AGI and still make a deductible contribution if you are covered by a plan or if your spouse is covered by a plan. The Roth IRA limits also move up similarly, and these are all found in Notice 2019-59. And a highly compensated employee will be $130,000 this year. There's a new one. It is still great CPE season now for all of you here in the States. Last week, I was, like I said, the previous week I spent my time in going across country for 3 different presentations in New Mexico, then off to Seattle, in Washington for their conference, and then finally in Boise, Idaho. This past week I did an infirm session and I did the Arizona Federal Tax Conference. This coming week, I will be doing some more infirm work, and I will be doing sessions here in Arizona. The sessions I'm going to be doing coming up in Arizona this week. The first session will be these 2 sessions both will be broadcast, so you can either take them at the Arizona offices or you can take them on the web. November 12th is Planning with Qualified Business Income Deduction, Section 199. That is the live session that will be rebroadcast by Cal CPA on the 26th. So if you want to take it live is coming up on the 12th, which may or may not be too late to take it, depending on when you're listening to this. Coming up on Wednesday the 13th, I've got 2 4-hour sessions. New businesses advising clients on related tax issues. We're going to talk about entity selection and the pros and cons and some of the things that happen there. And then estate planning for the 99%, how you deal with clients who have qualified retirement plan issues. I should say qualified retirement plan issues, also other issues. What's our issue for somebody who is currently not going to have a taxable estate? And that's going to be true either because the combined estates of the 2 spouses will be significantly less than $5.6 million or so, or you believe that we're going to actually get made permanent, that higher level, which case then we got even more people that are in the, probably look at the 99.99% that we're doing estate planning for. So we're going to talk about how it changed and what the issues are different if you have a client who is not going to be subject to the estate tax, how we have to worry about doing estate planning. On November 15th in Tucson, I will be doing 2 4-hour classes. The first one will be on Arizona Accountancy Ethics. It is the ethics course you're required to have in Arizona to be relicensed. And then I'll do in the afternoon Arizona Income Tax Update and Overview. The next week I head off, I'm going to do 3 sessions at Minnesota's tax conference. So Minnesota has a tax conference. I'll be there on the first day of the 2-day conference doing those sessions. Then I'm going to be making my way over to New Jersey. On November the 20th, I will be doing the full Advanced Tax Update course, November 20th, in Iselin, New Jersey at the APA Woodbridge Hotel. It's right next to that Metro Park Amtrak station, if you want to know kind of where it's sitting. So you can actually come over there. I've been over there a few times, so I'm used to getting out there. We'll be doing a session, Advanced Tax Update. Advanced Tax Update is basically the stuff we talk about here, but we try to do it assuming that the room has a lot of experience So we're not going to spend a lot of time on, let's say, some of the simpler things we might talk about. We're going to assume that we're talking to a slightly higher level audience. If you are an experienced tax practitioner with, let's say, 5 or more years of experience, and you're the person involved in doing planning and that sort of work, and you're used to, and you want to deal with things on a deeper dive level than we do in a regular tax update course, you might want to show up for this advanced tax update November 20th in Iselin, New York. Not New York, New Jersey, at the APA Woodbridge Hotel. Okay, I'll see you guys there. Okay, otherwise, this is it for this week. Don't forget our regular updates are at currentfederaltaxdevelopments.com. We do those things there. We'll post things as things happen during the week. I do have the table up there for the new life expectancy table we will probably be using. I have links to the inflation updated stuff. We'll have also more information as we get developments this week and I start writing them up. If you have any questions or comments, send them to me, Ed Zollers at currentfederaltaxdevelopments.com. I also follow discussions. I follow discussions on the subreddit at /r/taxpros. There we have a discussion there. I follow state society discussions. I follow Tax Talk for Cal CPA. That's at groups.io. There's a little more complex way to get signed up for it now. They moved off Yahoo Groups because Yahoo is obviously not planning to update Yahoo Groups anytime soon, and clearly is kind of phasing it out. Lots of things were disappearing, so we're not going to see that one anymore. And then I also follow the discussions on the listservs for Arizona, Minnesota, and New Jersey on their Connect sites. So if you're a member of those societies, you can sign in there and watch what we do on those sites. Otherwise, check back in here next week and we'll talk to you about what's been going on in the area of federal tax.